Hello, everybody. I got Mike McGowan on the phone with me, and he works. We work real closely together. Actually, he's an advisor to USA Capital, the private investment company that I co-manage. And what he does is sometimes he travels around and checks out some of the companies in person and does other research. And boy, you've been traveling a lot the past month or so. Actually, both of us have. We went to the Vegas Gold Show, and you went to Bolivia.
Yeah, I was down in Bolivia, checking out the site at Eagle Crest, and I'll have a little bit more to share with you on that. You know, when we get farther along in the program. But it's been a crazy summer. Glad to be back, but looks like we're about ready to hit the road again this weekend, huh, Mike?
Yeah, that's right. You're going to the Denver Gold Show, and I'm going to one in Toronto this weekend. Was it? Mine's Sunday, Monday. I think that's the same of yours, too.
Exactly. Sunday, Monday, Tuesday, yeah.
Well, you've been doing some interesting research into central banks and in the so-called Washington Agreement. Would you care to elaborate on some of that?
Sure. Well, you know, one of the things that I've gotten a lot of feedback from subscribers as well as my own clients is what happened to gold, especially when everything looked so poised to break out. And you know, in the spirit of true confession, we felt the same way. And you know, when we're looking at trades within the fund, I mean, the charts had really gave us a nice consolidation period. We thought things were going to move up, and what ended up happening was it just took the opposite effect. Gold was, you know, trading in the mid to high 600 level, and has dropped, you know, almost 100 points, and it caught everybody off surprise, and it disturbed me, and so I started looking into a lot of different positions and theories, and one thing that has not been totally propagated, but it's also not new, is how involved the central banks are in the gold supply. And what I've come to find out is there's been two agreements that have been agreed to over the past several years. The first one was called the Washington Agreement, and it was signed in 1999, and it lasted 5 years to 2004. And it was basically called the Central Bank Gold Sales Agreement, where each bank, both European, you know, most of the central banks in the world would have signed on to this. Now there are some that have not, but a good majority of the central banks around the world have signed on to this. And what it is that it goes on fiscal years. And what's interesting is the fiscal year ends September 26th, and the next year
Tuesday,
begins.
Right?
That's next Tuesday,
Sure.
and the second and the third year of this contract goes into starts September 27th. Now, I will say that it started in 99 and it went to 2004. The second central bank gold sales agreement was put into effect in 2004 and extends to 2009. So there's another 5-year period.
But this basically gives them a window of when they can sell their gold, if I understand correctly. And then, so after September 26th, you know, they won't be able to sell until when, next year sometime?
Well, there's an annual quota of 500 tons per year that can be sold between all the collective banks that have signed up to this. That's the maximum they can sell. And typically, you begin to see these sales, and most of this is tracked through the IMF when the monthly IMF stats come out. And I think one thing I'm going to be taking a close look at, and I think our subscribers should too, is when the IMF stats come out, and it'll come out somewhere in December of 2006. What banks have been selling, but I do know from a fact, for a fact from the previous reports, that at the end of July, there was only 340 tons of gold sold into the market. So in September alone, we saw 40 tons come from the European central banks alone. And what seems like once the price of gold got up there high enough, they began to sell into that market, and I'm fairly well convinced that is one of the primary reasons and is a major factor behind the recent gold decline, is that they've had to get these quotas off their books, they've sold into the markets, and after that selling is done, which is next Tuesday, I suspect that we'll start to see somewhat of a reprieve in the gold markets. Now, that's not to say they couldn't continue to pound the bullion back into the public markets, but that would definitely be a new year for their quota. And typically, if history is any guide, they let up from that particular aggressive selling pattern.
Well, it's I wrote something on the website last Sunday that it was titled something, why is gold falling and where's it going? And I didn't talk about any of this. I was mostly concerned about the technical factors of why we had a false breakout. And I blamed a lot of the selling, and I was really talking about the gold stocks in particular, not instead of just the metal, on people who got in earlier this year near the top, who really never got in the gold market before. And you saw a lot of attention on the television, CNBC, Jim Cramer, and various other people. And gold, for a short period of time, became mainstream. So I think a lot of these, regular mainstream investors were sitting on losses all summer, and when the stuff failed to break out, they just dumped it, and that, kind of snowballed as we've gone lower. More and more of these people have been selling, and when you get declines, that's what happens. Towards the end, you finally have panic of people who are disgusted. But that doesn't, I don't really think those people are in the gold, precious metals market itself, like buying futures or anything like that. If, in fact, they would be buying the ETF.
Like GDX and what have you.
Yeah, and GLD. And actually, it's interesting because there was a pickup in volume in both of those in September.
Well, one of the things that was interesting to me, Mike, when I was doing the research is, both the Federal Reserve and the European central banks haven't hid this. I mean, for instance, when Greenspan was the chairman of the Fed, he gave his testimony to Congress on July 24th of '98, and he, quote, "Central banks stand ready to lease gold in increasing quantities should the prices rise." And the European Central Bank, when they signed the original Washington Agreement on September 26th of 1999, acknowledged, openly that they got together to regulate the price of gold through gold sales and leasings. And by the way, I've got two direct links to both of their websites, whether it be the Federal Reserve or the ECB, to support that. So this is not something new. It's just when we're in the markets, we've got to keep an eye on the outside factors, because they really can, they can make the ride pretty damn rough. Somebody that's not seasoned is certainly going to get seasick and, probably get rid of their shares. But for those that are committed, it's nice to have that outside information when you're starting to see supply demands really come into the market. And this is pretty easy to track, and we can do that through the IMF statistics.
Sure. And I think it's also, there's always a move behind the chart, something causing it. And instead of, fundamental reasons, it has been speculated by some people that the economy is going to slow down, the stock market is going to collapse, China is going to go into recession or whatnot, and that's going to ruin the commodities and precious metals market. I think it's more likely that the reasons behind the decline in gold are these factors that you've been able to dig up.
Yeah, well, and the other thing is that, gold is a tangible commodity, right?
That's right.
So the supply side increased because of a quota. The demand side hasn't decreased. And so, I guess I'm relatively optimistic that we're going to see, or we could see, a nice rebound in the precious metal markets once this supply side, basically comes to an end.
No, I think so too. I think we should see it next week, and we should need to wrap up, but we'll get back on this subject a week from now.